Let's get to our first trader of the day. It's pro trader Brian Stutland, the founder of Equity Armor Investments. Good to have you here. It's been a rocky week with the market mostly going down. Yet if you pull up a one-year chart, the market still is not even close to the low set in June.
Well, yeah, I mean, we've come so far off those lows from June. And what's interesting is when two-year interest rates or shorter-term interest rates or predictability of where the Fed is going with interest rates, those are all reaching the peaks on the year. And it's interesting that the market hasn't gone back down to the lows. Now, I think the market's turned a little bit further down the yield curve, looking at the 10-year note, saying, okay, if the 10-year note doesn't get above 3.5%, we don't have to be as concerned. But to me, I think there are a lot of issues out there, whether it's what's going on in Taiwan and China and the tensions there, or potential energy crisis, a serious one in Europe this winter, and what they're going to do. I know they put some things in place to maybe put some caps on energy prices, but that's still an issue in the back half of this year as the weather starts to get colder. So I think there's a lot of underpinning stuff out there, not just looking at the 10-year note, where we could be in trouble and we could, in fact, actually retest those lows going forward. I'm a little bit more cautious these days, Angie.
Brian, where is money going and where would you hide money right now?
Well, if I'm looking for places to kind of run and hide, I think what looks interesting here is if you want to look at some of the corporate bonds, some of the credit spreads have actually tightened a little bit on shorter dated bonds, meaning you could buy a 2-year corporate bond, let's say on Apple, for example, a stock that we own for our clients. But if you're looking at the bond market there, that could be an area where you stay a little bit short dated. So even if interest rates rise, what happens is you still are protected there because you just hold on to that bond till the end. And it's such a short duration that you don't have a lot of bond price movement and you get to collect that interest. So I'm seeing a lot of conservative people sort of move into that area. That's an area I like. The other area too, people just, looking to hedge their portfolios and limit their risk to the stock market. We had such a huge run up. We made it up 50% off the lows to what the year-to-date high was. And after we got sort of there, I had a lot of word on the street from investment advisors, talking with their clients saying, let's find some ways to take it off the table, hedge some of our equity risk. And so that's another area I really see going in there in case we get this huge, big volatility pop in the back half of this year.
We always appreciate having you here. Thanks so much, Brian.
Thank you.
Go to businessfirstam.com for where to see our show on TV.